should I invest or not? Because the people, that's what the people want, right?
Okay, so the answer is no. Next question.
Welcome to Bare Naked Money, the podcast where we strip down the complex world of finance to its bare essentials. With your hosts, Josh Shellick and Colin White, portfolio managers with Verican Capital Management, Inc.
Welcome to the next episode of Bare Naked Money. Colin and Josh here, coming at you as usual. And we're here to pull back the shower curtain as we always do, talk about money the way it should be talked about, plainly, close off, not literally, of course, and without the sales pitch. Bare Naked Money here, portfolio managers at Verican Capital. If you're looking for straightforward advice from a firm whose only angle is to make you better off and better informed, visit betteradvice.ca to get started. And Colin, today we're talking about IPOs.
Yes, we are, because we do the topical things everybody wants to hear about. And I bet you that there's a good percentage of our listening audience that doesn't know what IPO stands for. So I figured we'd start there. Josh, what does IPO stand for?
Initial public offering
There we
is
go.
what it is.
There we go. So in the life cycle of a business, somebody gets a great idea and they start a business up, then you go through a series of funding, and they can fund it different ways. They can go to friends and family, they can borrow, they can go to venture capital, they can go to angel investors. But most of the people that invest in those companies someday want what they would call a liquidity event. They want to take the company public so that they can make a boatload of money off being successful early investors and sell it off into the world. So there's a bit of a life cycle to a business that gets to the point that it wants to be a public company. And in the last few years, we've had a concern that our public markets were getting too small. There was too many companies being taken private. And recently, it seems that the tide is going back out again, and public markets have become popular. So, Josh, any idea why going public right now has gotten more popular? Did you want to tackle that one?
I have a few ideas, but we should just distinguish between public and private for everybody.
Listen,
So
yep.
private is your friends and family, somebody that you call up on the phone and say, "Hey, do you want to invest in my business?" Anybody that you can call through, we would call, I guess, an over-the-counter type of relationship. You find somebody or they find you, they give you money to invest in your business. That would be a private relationship or private funding. Public is this beautiful thing that we call the stock market. When you're going to the stock market and raising capital, raising money, and listing your company on a stock market, on a stock exchange, that's a public business. So, as you can imagine, being public just makes your company available to more people and more people's money available to you as a company. So I think what we've seen over the last couple decades really is more and more companies staying private as it's been more there's been more money accessible through private channels than there has been in the past. And I think that's probably more true today than it ever has been. As you can just think of it logically, it's easier to connect with people than it ever has been. So therefore, it should be easier to raise capital from people on a private basis than it ever has been. But at some point, you've tapped out all of those different tentacles, all of those different connectors that you can make on a private basis. You've tapped those out. There's no more money available. And there could be the cynical view of this is if you want to get really rich and get the public money and jack up the value of your company, then maybe that's the outlet. I think maybe the more practical and more common reason is once you've tapped out the availability of private money, if you still need money to grow, then public is really your only option.
Also important to note here, there can be some different motivations. Private companies do not have the same kind of disclosure requirements. If you go public, there's lots of rules, regulations, and it's very visible. And I don't know where I heard it, but there was a great quote. Lack of transparency has never worked in the favor of an investor. And the private markets, and with the popularity of the private markets recently, they've kind of leaned into that. So there are companies that like the private space because they don't have to be as fulsome with their disclosure. It's less burdensome. It's less cost. Like you have to spend less money on reporting and things of that nature. So there's a trade-off when you go into the public markets. Yes, you can, it's accessible, but it's very expensive and it requires a lot of disclosures. And you lose a little bit of the control in some ways as to what the value of your company is. Like try hard to, and we'll talk about this, I think, as the pod progresses, but they try hard at the time of the public offering to get the most that they can for it, because that's normally when the insiders are selling off and want to see some of that money that they have earned by investing in early stages in these companies. So yeah, is that a good enough of a foundation, Josh, do you think, to have people understand some of the rest of the silliness we're going to get into?
Yeah, well, we've gone 5 minutes without mentioning the word SpaceX, so I think that's successful. We can already chalk this up as a successful podcast
You're,
because that's kinda why we're here
well,
today, I think.
we've lost listeners because everybody else wants to hear SpaceX in the first 30 seconds. So
Exactly. Yeah, yeah. So I think as we usually do, again, pulling back the shower curtain, providing a little bit more of a grounded viewpoint. We're here to provide some facts and some observations about IPOs. SpaceX obviously being the most, well, literally the largest, most prominent IPO that we've ever had. So it's a good time to talk about it.
where do you want to start, Josh? Do you want to start with some of the things that may have influenced this, inclusion in indexes and stuff like that, or do you have a different order you'd like to?
Well, why don't we just start with IPOs? Should I invest or not? Because the people, that's what the people want, right? So why don't we go right there
Okay.
and talk about IPOs? I think that will feed into some of the other points and the more minutia of this deal.
Okay, so the answer is no. Next question.
Okay. Okay, let's move on. Okay, so but why do you say no? Why do you say no? Where does that come from?
There's a few things that go into how they design an IPO. It's designed to be in the favor of those making the IPOs. They're only going to come to market under favorable conditions. So there's ways that they can control that. So they have a lot of PR behind it. They have a lot of mechanisms that they can use to make themselves look really attractive, and for that moment in the sun. And there's still mechanisms, and we'll dip into this. There's things like called torque, like what percentage of the company is actually going public. So if it's a small percentage of the business, and this is very common during the dot-com days, they would take a very small percentage of the float, throw it into the market. And because it was a small supply, the price would get perhaps artificially valued at a higher level, and then therefore increasing the value of the founders or the original shareholders. Because again, the way they value it is based on the most recent trade. So there's a lot of mechanisms that can be pulled, and it's kind of an asymmetric relationship. The person coming to market gets to decide if they want to sell, and they will typically only sell under conditions that are favorable to them. And it's probably one of the more manipulated, visible things out there, because typically if you're buying a stock, you're thinking that hey, I think the market hasn't accurately valued the stock at this point in time, and therefore I can take advantage. And it's just a really, really difficult time because there's no real track record that you can look at that means anything with regards to how the company's performed. So it's very cloudy, it's very murky, it's very heavily manipulated by big players, and the average retail investor, is just going to be ground up in the gears. Can you make money on an IPO? Absolutely. Is it clear that you can? No. I think it's probably the most difficult time. Because if you look at another company that's been in existence trading publicly for 10, 15, 20 years, okay, maybe you can learn something about them. And the market's had a lot of time to self-level, so the pricing should be a little bit more understandable or relatable to the business. IPOs are just pure speculation, and I don't feel that retail investors should be speculating with any money that means anything to them.
Yeah, well, I think the thing that I would just highlight from what you said there is, are you as a business owner going to sell your business when the market is poor? No. The obvious answer is no. You're going to wait until the market is very, very favorable and things are looking very, very rosy for your business. And you're going to sell your business at that time, which means the price is going to be high, which means the hurdle or the bar is going to be high for excess returns going forward. So that's, I think, by and far the biggest thing that's an impediment to these being really wealth creating investments. But we can look at the facts too, right? And that's I stumbled upon Mr. IPO as I was telling you not long ago.
Yeah.
So this is an academic who's done a lot of research and studying and provided a lot of statistics on historical IPOs going back like 40 or 50 years. And we're looking at thousands of IPOs now and how they perform. And so interestingly enough, because You hear IPOs are a bad investment a lot of times, and I've been hearing this as long as I've been in the industry, and I think by and large that's true. But he kind of breaks it down in a little bit more of a nuanced way, and there are ways to make money off of IPOs, I think, consistently. But the trick is you need to be an investment bank to do that. For an individual,
Oh yeah. Oh,
very, very
if I
challenging.
can collect my 9% fee, yeah, I'm going to make all kinds of money off IPOs.
Yeah. Yeah. So anyway, I was going through parsing this research a little bit, and IPOs in general, on average, tend to lose money. Not just underperform the market, they tend to lose money. That's pretty significant because that's how you should be grading any of your investments relative to a market related investment. How is this performing? And again, on average, it's quite poor. Now, if you can get in at the IPO price, which is the investment bank, right? There tends to be a very, very attractive first day return. If you're everybody else, including us, you're buying probably sometime on that first day, your return outlook is very, very poor from that point forward. And that's pretty much no matter how you slice and dice the data, top to bottom, side to side. That's the way that it works out. So the real reason I would say avoid IPOs is I like to invest based off of probabilities. The probability is if you do IPO investing enough, you're going to lose money on it, or you're not going to perform as well as the market for sure.
A little bit deeper into it because I've watched the private equity guys who are trying to buy businesses saying it's like I'm going to buy a business that's growing at 20 to 25% per year. It's not founder specific. It's got a a good team that runs itself. Those are the businesses I want to buy. It's like, well, shit, if I owned a business that was growing 20 to 25% per year, then it was on autopilot and had no risks, why would I sell it? Like I can't reallocate that capital into another similar investment. So when somebody gets to the IPO stage, you can infer from that that the perhaps the largest part of the growth of the business is behind them, and they don't think that the future looks as rosy as the history has looked. Because again, if it was going to continue to be in a magnificent investment and continue to grow, they would probably be less likely to want to go public with it.
So that brings us to SpaceX as a potential investment opportunity. And as we said, it's fairly unique in that it's the largest IPO in history by dollar available. It's one of the largest by market cap IPOs in history, the value of the business. So there's a couple things that make SpaceX unique. One is the size of the business. And so I was looking through this data to see, do larger IPOs, larger companies that IPO tend to perform better or worse than the others? And seems like the dispersion is wider as you'd expect. There's if it's a large company, there's fewer big winners, but there's fewer big losers. But on average, I guess they tend to perform a little bit better, still lose money relative to the market. But the other part was the valuation. And we know now that the valuation of SpaceX is like 100 times sales or something like that. So the value of the company is about 100 times what it earned in revenue over the past 12 months. And those companies tend to be the worst performing ones. So you could look at this through a bit of an optimistic lens on SpaceX specifically, or a bit of a pessimistic lens on SpaceX specifically. I think no matter how you slice it, it's going to be a challenging environment for this company.
Well, yeah, and it's not just SpaceX, it's a bit of an amalgam. And this is where, but Josh, come on. First 16 pages are pictures of rocket ships. Like, I mean, who doesn't want to own a rocket ship,
Yeah. Interestingly, not even the biggest part of their business. The
right?
biggest part of their business is launching satellites into space for connectivity. So,
Yeah.
yeah, maybe a bit of misdirection there, but we talk about SpaceX, but really what we're talking about is some of the very, very large IPOs that are coming
Yeah.
to market this year. Because it's not just SpaceX, rumored, reported, OpenAI as well, and Anthropic as well, coming to market at some point later this year with IPOs. And the three of those combined are going to be three of the largest companies by market cap to IPO in history. And actually, I heard that if you add the three of them up, their market cap is about 50% of all of the IPOs that have listed over the last 50 years. So that's pretty crazy when you think about it.
I'm going to go on the record, or I am on the record, that an individual retail investor trying to trade one of these stocks right now, they're just going to get caught up in the stream. Like there's nothing really, there's no information out there that you're going to grab onto that hasn't already been fully analyzed and or built into the stock, and you're going to collide with really big traders doing really big things. Part of the issue is how disruptive could this be to the overall market, right? Because it's of such a size that it is going to potentially cause some ripples. And I think that is the part that's a little bit more concerning, that could affect the average retail investor, and they should be aware of it.
So you mentioned a couple of things that are happening with this one as well that are, again, a little bit unusual. But let me push back on one of
Oh,
these things that you
oh,
said. So you don't have any information that's available that the market doesn't have. But what about the fact that these SpaceX specifically is going to be introduced to the Nasdaq, to the FTSE, to the Russell indexes within the next week from when we're recording this? Isn't that going to provide an amazing boost for buying for the stock and drive up the stock price even higher?
oh, come on, Josh. I said, in fact, it's not known, right? That this is the biggest 15-day period of front running in the history of markets, I believe. Now, I have to do some research to back that up. But no, this gets into some of the gamesmanship that's going on, right? So let's just dive in for half a second. Because we shouldn't go too deep with this, Josh, because we'll lose me pretty quickly. I mean, I can go an inch deep in this pond, but this pond goes down for a little bit. But the one of the things that they negotiated, because the Nasdaq really wanted to get this listing, so Elon went to Nasdaq and negotiated with them an accelerated track to be included in the passive index, the index for the Nasdaq. So what that means, like indexes, we think are these holy things that are passed down from the top of the mountain, and they're just so immaculate that they're amazing in their purity. They're not. They're a product. They're a product that are put up by companies and they change. And this is a great example of it. So Elon went to the Nasdaq and said, I want to get included on your index. How fast are you willing to include me in the index? Because in his mind, that's going to force, well, factually, it's going to force a whole bunch of people to buy the stock. So it's a guaranteed audience, right? So he negotiated that it was going to be 15 days. And Josh, I don't remember what it normally is. Like normally months. There's a much longer period. Like this is a dramatic shift from where it was in the past, and it's different by index as well. But he got it down to 15 days. It's like, okay, so it's going to go to market, and everybody buying it right now knows that on that 15th day, all of the passive strategies are going to be forced buyers. So the simple math is, oh my God, like there's going to be so many buyers on that day. I'm going to jump in right now and I'll sell to them when they buy because that's going to drive the price up. You're not the only one that knows that. And if you think that the passives are sitting back and not hedging in one way or another about this exposure, you haven't been in show business long enough. So that goes in the category of it's widely known. So the net effect on that day, the 15th trading day, is going to be the net effect of all of the strategies, all of the biggest players on the planet have initiated trying to outposition each other. I just spent the weekend watching sailing. So the sailboats were always jockeying for position, and they were all headed to the same point, but they're all trying to get there differently because they were picking their strategy, right? So whose strategy is actually going to get to the most money at the finish line? It really depends on the confluence of all the different strategies coming together. Like you're not going to pick one data point and said, this is the one thing that is true. No, come on, pay attention. There's like, I don't know how many thousands of different ways to play this on hundreds or thousands of different scales. And that's all going to play out. If you're right, congratulations. But you gamble like that and go to the casino, they'll give you free drinks. Do we want to get into the other leverage and stuff that they use to goose up their percentage of the index? Is that too soon?
Well, there's a float adjustment. That's what you're talking
Yeah.
about, I think. So, but anyway, I just want to kind of highlight this point. I think the more obvious that something is, the less able you are to make money off of it.
Mm-hmm. Yeah.
It's as simple as that. So we knew all of this before SpaceX came to market, that all of this was going to happen with the index inclusion. So it seems that there's no chance to make money off of it because it was telegraphed from before it IPO'd. And actually, you'll be surprised, Colin, there's been research on this too. And whether there's actually a bump from positions inclusion in an index, right? And you could look at the S&P 500, which is probably the most followed index on the planet, and there's probably more passive money in the S&P 500 than I'm going to guess any. This is just speculation on my part, but I think it's probably an educated guess. There's probably more passive money tracking the S&P 500 than any index on the planet. And the research shows you that the bump on the day that a company is included in the S&P 500 these days is basically zero.
Everybody knows it's coming.
Exactly. And it's like, okay, it's coming a week in advance, so you'd position for it a week in advance, but then that week in advance is coming too, so you position for it a month in advance. How early do you actually position for something? So interestingly, the research showed that back in the 90s, there might have been some ability to front run this stuff, but that was a long time ago, Colin. The 90s, if you don't know.
Oh, that's fired. Yes, it was a long time ago.
The other part that you mentioned, so just to try as possible, so most indexes will not base the stock's inclusion and the weight of that stock based just on the value of the company, but how much of the shares are available for public consumption. So in the SpaceX scenario, I think somewhere around 95% of the shares or 95% of the ownership of that business is still privately held within a few hands of the founders and early investors. And the other, I believe the exact number is 4% of the company was what we call free float. So it's available to the public. And there can be different values of that depending on which company that you're looking at. But these indexes usually adjust the weight in the index based off of how many shares are available for public consumption. So you could debate whether that's right or wrong, but in this case, Nasdaq said, well, we're going to adjust the weight of SpaceX to 3 times what we normally would have for any other company just based off of the public float that's available.
Elon was saying, either do that or I'm going to go list somewhere else. So they went, no, we got you. Like, we'll give you 3 times. And it was funny because you were the one that pointed out, because the other thing that's going to play out here is that there's another 50 or 40 some percent of the company that's going to be eligible to be sold as lockup periods expire over the next 6 months. And the straight line math, and again, the straight line math is always wrong. It's like, if that goes to market at a certain valuation, that would make it, larger than Meta as a percentage of the index based on that lever, which, again, for a brand new company that doesn't make any money, that's trading at 100 times sales, doesn't make a lot of sense. I mean, for those of us who were alive in the 90s and watched the tech wreck, I'm not saying this is that, but it rhymes. Like, there are some things about it that rhyme. But apparently that's been capped. There's a threshold they're going to go through where the multiplier is going to go away, which will be another inefficiency in the market for a moment that everybody's going to try to trade around. There's a lot of gamesmanship that goes on, and a lot of very big players with very deep pockets are trying to basically tack across the wind to try to find the best currents to get to the finish line with the most money. So, but it's a big, very expensive game to play short-term trading like this, for sure.
Can I defend the indexes for a second?
Please. Absolutely.
You didn't expect me to say that, but so when you think of an index and a benchmark or a passive investment of some sort, in my view, it should be a fair representation of the economy or the value of the things that exist in the economy.
Mm-hmm.
And so if SpaceX is a $2 trillion company, which is roughly what it's worth today, like one of the top 5 most valuable companies on the planet, whether you agree with that or not, shouldn't it be part of an index? Shouldn't it be a meaningful part of an index from an early point in its issuance? Because because it stayed private for so long, or for many years, well, it grew to be a substantial size. Does that mean that you should not include it? Because that's kind of what the counter argument would be.
And that's fair, but existentially, if you want to step back even further, should an index not reflect the contribution to the economy of an entity, and one that doesn't make any money is not really contributing anything, so should be excluded entirely? I mean, I could go all the way there too, and that would be equally nonsensical. No, you're absolutely right. But this also goes back to the heart of what an index really is. And let's be honest, an index is a money-making machine, and they're designed to make money for the companies that have them. That's their number one priority. Now, we have taken them and they've leaned into, and part of their ethos is this is a representation of the overall market that is done in a very inexpensive way. That's their value prop. We're gonna provide you with something at a relatively low cost compared to alternatives that you can trust is going to be an amalgam and a representation of whatever, right? Because there's different indexes. Last time I looked, there are thousands of indexes around the world,
Thousands.
right? So each one
Mhm.
of them is staking out and saying we are equal weighted, small mid cap, growth company, whatever, like whatever you want to put on it. So when you put that moniker on it and people count on it for being a thing, you have to try to have fidelity to that. And you have to try to make sure that you're representing that if you want to continue to be successful for sure. So yeah, then this is the argument that Elon put through. Like, I'm so huge, look how huge I am. But he also kind of threw a whole bunch of shit together in a pile to make it huge. Like, this wasn't a company. This is not a smoothly operating business that's been running for 10 years. This is all of the side projects he's had. He's thrown all together in a big pile. How big is the Tesla fleet that he owns of Cybertrucks? Isn't he the largest owner of Cybertrucks, this company in the world? Because, well, Tesla needed to sell them to somebody. I mean, those kind of things, this isn't just one thing. This is a bunch of things that have been kind of cobbled together. But you just very eloquently made the argument that has been made by very smart looking people in suits that has allowed this to persist for sure. And it's not entirely without merit. I'll give you that one.
Yeah, and things that I would get up in arms over, this is really not one of them. Although it smells a little bit fishy, it's like, yeah, I can kind of see some sense to it at the end of the day. The biggest challenge that I have with this one is the data on IPOs in general, the valuation of this one specifically, like it's losing billions of dollars per year, yet it's worth multiple trillions of dollars. So you really, really, really have to trust and have faith in the brilliance that is Elon to pull this into a company that's growing at enough of a rate that it's going to grow into the
Okay.
valuation, which is, I don't even know what that number
Well, I
is,
was
but
just
it's got
say,
to be astronomical.
those-
No pun intended.
you just glitched. It was like growing at a rate. I don't even know what the rate could be that would justify this. I mean, and he's got a nice bonus in there for him if he ever reaches Mars. So that this is the document that they're operating by. But Josh, do you want the happy ending?
Yes, give it to me.
This is wrong on many levels, and it smells on many levels. The average retail investor can still invest in the stock market and expect to make more money there than they're going to make other places. These two things can be true at the same time. You can have something at this scale that's just nonsensical come into the marketplace, and the wrong people perhaps are going to profit from it, and it's going to hurt some people. But that does not invalidate the overall idea that the stock market does every generation create value for the retail investors who invest in it. So as much as we make fun of it, this is not your excuse to go bury your gold in the backyard. And yes, I'm speaking directly to Nelson, British Columbia. You can still participate in the market and have a reasonable expectation. Now, just don't think you're smart enough to be able to play, the big stories like this because, yeah, it may make a lot of money or it may not. We already have some disappointed people, Josh. This hit 220 as a share price, within the first couple of days, and it's been, you know, I wouldn't say plummeting, but it's not trading at 220 anymore. So there are already disappointed people that are invested in this trade. Maybe not as disappointed as the Bitcoin people sitting at $63,000, valuation of Bitcoin, but there's already disappointed people here. But I want to earn my title of being bleakly optimistic. Yes, this is bad. Like, yes, they're playing all kinds of games, and they're playing games I'm disappointed that they're allowed to play on some level. But that's okay. This is just entertainment. You can still make money in your S&P 500 exposure, your Canadian exposure, your global exposure. You're still going to be able to make money in spite of everything that's going to go on. Is that a good save, Josh?
It's a great save. And I would just sum it up as stock market is a great place to build wealth. and it's a little bit better place to build wealth if you avoid IPOs.
Wow. Good change. Good job, Josh.
All right, folks, thanks for listening to Bare Naked Money. As always, if you're starting to wonder whether your current financial advice is as clear, disciplined, and conflict-free as it should be, maybe a conversation worth having. Josh and Colin here, portfolio managers at Verican Capital Management. Our team is always open to new client relationships and conversations. Visit betteradvice.ca to get started.
Have you ever wondered why your financial advisor is making a recommendation? In an industry where conflicts of interest are everywhere, it's important to understand how they affect you. For more info, contact us at Verican. You can find us at annoyingthecompetition.com.
For more information on the subject of today's podcast or any other financial topic, please visit us online at verican.com. That's VERECAN.com. There's plenty of information there, or you can reach out to someone on the team. Thanks for listening.
Please note, the information provided in this podcast is for general information purposes only. It is not intended as financial, investment, legal, tax, accounting, or other professional advice. Our discussions are not a solicitation to buy or sell any securities or to make any specific investments. Any decisions, based on information contained in this podcast, are the sole responsibility of the listener. We strongly advise consulting with a professional financial advisor before making any financial decisions. Listeners should be aware that investing involves risks and that past performance is not indicative of future results. Bare Naked Money is produced by Verican Capital Management, Inc., a licensed portfolio management company in Canada. We operate under the regulatory framework established by the provincial securities commissions in the provinces within which we operate. The views expressed in the podcast are our own and do not necessarily reflect the official policy or position of any regulatory authority. Remember, at Verican Capital Management, Inc., we focus on aligning our goals with yours, prioritizing integrity and transparency. For more information about us and our services, please visit our website. Thank you for listening, and let's continue to challenge the norms of the financial services industry together.